Beware, citizen, you are now departing from the world of allowable opinion. The Tom Woods Show.
Welcome, everybody, to our first program of the year, January 2nd, 2014. Happy New Year. We are starting the year off with a bang here with David Stockman as our guest. David Stockman is former director of the Office of Management and Budget under Ronald Reagan from 1981 to 1985. Before that, he was elected to the House of Representatives in 1976, where he served until 1981. He went to work on Wall Street after leaving Washington, and finally started his own private equity fund company, Heartland Industrial Partners, based in Greenwich, Connecticut. He is the author most recently of the incredibly fantastic, indispensable, thoroughly enjoyable, and establishment-smashing book, The Great Deformation: The Corruption of Capitalism in America. What a fantastic book. All the arguments you've heard about the financial crisis and how the geniuses all solved it for us, and we were about to drop dead, everybody, and the economy was going to disappear. We actually had, I'm not kidding, Rachel Maddow on one of those late night shows actually saying that, well, thanks to the bailouts, at least we have an economy. What does that mean? We wouldn't have had an economy? Total craziness. He smashes all that and gives an incredible, wonderful, sweeping, revisionist account of 20th century U.S. history without all the obeisance to great presidents and the Federal Reserve. Absolutely fantastic. I urge you to read this book, and I'm really glad to welcome right now David Stockman. David, thanks for being here today.
Delighted to be with you, Tom.
Let's start off with Paul Krugman. I'm sorry to ruin your new year so soon, but he's been saying now in recent months that what he will call the deficit and debt hawks have really been routed. He says that right now the estimates of the deficit are being lowered in people's minds, and it turns out that really this is all going to be manageable after all, and this was just a whole lot of sky is falling hysteria. So how do you answer Krugman?
Well, he's saying two main things, both of which are wrong, which is not surprising. Number one, he's saying the market doesn't care about the level of debts we have today because interest rates, the taper notwithstanding, are still exceedingly low by historic standards. Secondly, he's saying the deficit has come down in percentage terms by a lot, therefore why worry? Both of those are essentially, propaganda ploys that ignore the underlying reality. Number one, the reason interest rates are even at today's level, turn of the year level at 3% on the 10-year and, 40 basis points on the 2-year is because the Fed is still massively in the market buying debt, notwithstanding their announcement. They're still buying at an $85 billion annual rate, right in the heart of the yield curve. The Fed has not abolished the law of supply and demand, and so therefore, as long as that massive bid is there every day from the New York Fed, interest rates will be artificially low. That is not, therefore, the so-called bond vigilantes giving Washington a pass, a green light to keep borrowing. That's the Fed monetizing the debt and creating the distorted, deceptive appearance that all is well, which permits unreconstructed Keynesians like Krugman to say, see, I told you there's no problem. The obvious point is we got $17 trillion of national debt now. It's rising at a trillion rate, and we'll get into that. We'll soon be at $20 trillion. And when interest rates normalize, because sooner or later the Fed will taper, its buying of this massive daily dose of bonds will decline, diminish, and then ultimately be eliminated. Real interest rates, normalized interest rates, will be 200 or 300 basis points higher, I believe, at minimum. And the carry cost on the debt will explode. And I'm not sure what Krugman will say then, but he'll probably have some excuse. The second thing is the deficit level in 2013, the year just passed, came down, but it came down from the stratosphere which was created by the bad policies, monetary and fiscally, of the past. But if you look at the $750 billion reported, and you recognize there's one-time gains in there because of the huge rush to realize capital gains, pay bonuses and special dividends and so forth at the end of last year before the fiscal cliff. And if you also recognize the phony 60, 70 billion that has been put into the Treasury coffers by Freddie Mac and Fannie Mae, it was just an accounting gimmick, not real or sustainable deficit reduction, then the number for 2013, which is really the fourth year of this so-called expansion, is running at about $800 billion, which is 5% of GDP, and by any historic standard, that's exceedingly high, dangerous, and more importantly, it's well into this expansion. Again, I say Krugman does not remind people, because he doesn't know it himself, that the business cycle hasn't been abolished. This cycle will end. We will have another dislocation, another recession, some other economic upset. And when that happens, and we're still 5% of GDP deep into the deficit, it will explode upward from that level, and the true nature of the fiscal calamity that is embedded in policy today will become evident. So again, unfortunately, Krugman and much of the mainstream media continues to selectively pick and misinterpret short-run data that completely ignore the underlying rotten policy foundation that undergirds the day-to-day, movement of the economy and the headlines that get reported.
David, I find it very interesting, maybe 3-4 weeks ago, when Larry Summers, it was claimed, was saying that bubbles may be a good thing, and it turned out he wasn't saying that, but what he was saying was something not a million miles remote from what you've been saying, which is that recent growth, if you can call it that, in the U.S. economy over the past several decades maybe, has really just been a matter of serial bubbles, one after the other. And he's saying that, of course, it would be better if we could have an economy that could grow without bubbles. But I thought that was an interesting admission on his part. How do you by the way, let me also add to that these are the same people, Krugman and Summers, who say we shouldn't be worried about inflation. Why are you people worried about money creation? That's not the issue. And yet they turn around and say, gee, it's funny, the economy seems to be shot through with bubbles. Well, no point in worrying about what's causing that. So how could this have been avoided? Like, what were the mistakes that were made? How could we have had healthy growth?
Well, there's a lot of different questions embedded there, Tom, and it goes to the heart of, the whole deformation, the great deformation, as I call it in my book. Bubbles do not create wealth that's sustainable and that's broadly available to the working population of a free market capitalist system. Financial bubbles engineered by the Fed create artificial, temporary financial asset inflations, virulent ones, as we can see now, that result in temporary windfalls to those who own risk assets and the stock, which is about 10% of the households own 80% of the risk assets, and really the top 1% probably owns half of that. So windfalls are created, but bubbles can't be sustained indefinitely, even by the central bank. And so now we're in what I call a serial bubble economy. The Fed has become a serial bubble machine, and we're in the third great bubble of this century. Remember, .com was dismissed in 2000 as an aberration after it crashed and the households of America lost $5 trillion worth of asset value. And then actually Krugman at the time said we need to get out of this temporary dislocation quickly. Why don't we have a housing bubble?
Yeah.
He actually said that in 2002. We got a housing bubble which was destructive beyond belief, as we now know. It turned not just Wall Street, but all of Main Street America into a gambling casino. Millions of people got caught up in it. We got the whole subprime housing price bubble and the crash that followed. But, 7 or 8 trillion worth of household net worth again was wiped out in that bubble. Then we had, obviously, the meltdown in 2008, the credit bubble around Lehman collapsing, and another big wipeout. Well, here we are today, and the Fed basically has doubled down after September 2008. We know the massive, unprecedented, radical expansion of its balance sheet that has occurred, but I think sometimes it's worth repeating. On the eve of the Lehman collapse, September 15, 2008, the Fed's balance sheet was roughly $850 billion. It had taken 94 years to get there, a little bit at a time. I'm obviously not saying policy before then was perfect. There were good Fed chairmen like Volcker and William McChesney Martin, and there were awful ones along the way like Arthur Burns and Greenspan. But the point is, it took a long time to build the balance sheet to $850 billion. Bernanke doubled it in 7 weeks. I think that needs to be emphasized over and over. It was just madness. They opened up the spigots. In 13 weeks, they nearly tripled the balance sheet. And here we are after a few more rounds of additional experimentation, QE 1, 2, 3, and so forth, at $4 trillion and rising, because the taper they're proposing is so minuscule that it means the balance sheet of the Fed will be heading towards $5 trillion over the course of this year. Now, when you put that kind of expansion, 5x in a very short period of time, a little over 4 years, you begin to realize that we have a rogue central bank, that it's utterly out of control, that it's abandoned any kind of historic notion of financial discipline, of sound money, of what it takes to generate real growth and healthy living standard gains in a free market economy. And that's why, notwithstanding all the talent we have in America, all the great businesses, some of the new technology that's coming along, notwithstanding all of that, I am quite pessimistic because the underlying virtues and strengths of our capitalist system are being totally compromised and eroded by this rogue central bank and a Washington fiscal policy that is enabled by it.
Now, sometimes people like us and Ron Paul will say things like, the policies of the Fed tend to benefit the wealthy at the expense of everybody else. But if the Fed is responsible for bubble after bubble, yes, that's true. That leads to asset price inflation, and that can help my portfolio. But if that's going to wind up crashing, then I, too, am harmed by this. So who really does wind up benefiting in the long run?
I think that's really a good point. And in the real long run, I think no one does, because obviously this isn't sustainable. It's heading for a crash landing some way, somewhere down the road. And even the 1% that are sitting on massively inflated real estate values, massively inflated so-called risk assets, and particularly high beta stocks, will lose as well. And this isn't, some kind of prediction out of the blue. It's simply a statement of what we've already observed in the earlier, smaller crashes we've had in the past. Today, the Russell 2000, as an example, is trading at 85 times trailing earnings. That's absurd. It's a massive overvaluation. The Russell, which is kind of the mid and small cap stocks in America, has boomed by 40% in the last year, whereas earnings of those companies, have barely increased at all. It's all multiple expansion. It's all a, front-running speculative move driven by the easy money and daily liquidity injections of the Fed. But when it crashes, the people who've speculated will lose their shirts as well. That happened, in the 2008 crash. The Russell 2000, from the time of the dot-com bottom in 2002 to early 2008 had risen from 350 to 850. So that's a huge rise over 4 or 5 years. And 11 violent trading days after the Lehman bust through the bottom in March 2009, all of that gain was lost. The Russell went all the way back to 350, and maybe some of the ultra-smart speculators got out of the way early, but when you have that kind of violent post-bubble or bubble burst, almost everybody loses, and I think that's the kind of scenario we have in front of us. These markets are massively pumped up. They are valued well beyond any reasonable sense of where the economy can go because it's struggling just to move forward by a couple percentage points a year. And as a result of that, when the next bust comes, we're going to have some serious broken furniture, even in terms of the assets of the 1%, because I believe the central banks are running out of tricks. They've got the interest rate at zero. They cannot possibly buy debt at a more rapid rate in the U.S. or Japan than they're doing now, or all the debt will be monetized within a few years. So I think we're reaching the day of reckoning, and when it happens, then even the false prosperity of the 1% will be under serious jeopardy and decline.
You know, I have other economic questions I want to ask you, but I'm kind of interested, though, in something that may be a bit more personal. I wonder if you could tell us something about the evolution of your own thought since you were in the Reagan White House in the early 1980s to today. How much in your own learning and reading have you found that your views have changed, or have you just simply amplified views that you had in the early 80s, or you feel like you understand things better now? How is the David Stockman of 2014 different from the David Stockman of, say, 1984?
I think that is a good question. I appreciate you asking it. The three principles that I adhere to today that are embodied in kind of a revisionist history in my book are, the principles that are fundamentally important to sustain liberty and prosperity in a free market economy, I believe, are 1, fiscal rectitude, 2, sound money, and 3, honest free market capitalism where we allow winners to win and losers to suffer the consequence. I believe that when I was in the OMB and the cabinet in the Reagan White House in the early 80s, we struggled for some of those goals. I finally left in 85 because I believe fiscal rectitude had been lost. And I wrote about that in my book, The Triumph of Politics, that I published in 1986. Now, what changed since then is I did not realize during the many years that I was in the Wall Street, in the financial markets, in the buyout business, how seriously monetary policy was drifting from the principles of sound money that Reagan articulated while he was in office, that he observed by supporting Volcker when he wrung this virulent inflation out of the economy that had been created by the Fed in the 1970s. But I wasn't really tracking day to day the evolution of policy under Greenspan and then Bernanke until suddenly that is monetary policy and kind of discretionary activist central banking. I didn't see that the Fed was turning into what I call a monetary central planning agency, that the Open Market Committee was getting so deeply, implanted in the day-to-day operations of the financial market and the economy that it amounted, as I say in my book, to a monetary Politburo. I didn't really focus on all of that over the intervening 20 years until suddenly I got a wake-up call when Lehman melted down and failed. And suddenly you had all of Washington jumping into this massive frenzy spree of bailouts and money printing, and Bernanke saying that a Great Depression 2.0 was at hand, and he opened up all the spigots and, tripled the balance sheet and so forth, as I mentioned before, in a short period of time. I then realized how far off base monetary policy had drifted, that obviously the meltdown going on in Washington was simply the financial bubble bursting that the Fed had created in the housing market and in the credit market and the stock market and so forth. And I was appalled when not only the Bernanke Fed did this, after all, Bernanke was appointed by Bush, but then when the Bush White House and Treasury under Paulson, sort of doubled down, jumped on the bandwagon, and forced through TARP on that second vote, even when most of the Republicans in the House really knew that this was the Rubicon. They were finally throwing the three principles overboard that I described at the beginning here. That is, free market capitalism was gone. It was now pure crony capitalism. Sound money was a joke when you're expanding the balance sheet and monetizing debt at that rate. And, fiscal rectitude, the Republicans had more or less abandoned many years earlier when Cheney said, deficits don't matter. But now, when they push through TARP, a Republican administration pushes through TARP at $700 billion. Soon thereafter, not only bails out Wall Street, but GM and the auto industry and much else. Then, that was the wake-up call. The three principles had been fundamentally defiled, had been fundamentally abandoned, not only by the usual suspects, the liberals and big government lobbies of Washington, but by the very Republican Party itself.
David, you've been very generous with us today, but I can't help asking you just one more thing before I let you go. And where would be the fun if I didn't ask you something a little bit more challenging? And that is, I don't want to put words in your mouth, but I think reading The Prose of the Great Deformation, which is a book that I have promoted like crazy. I was at a conference where I actually held up my pre-publication copy and said, I'm selling my own books, but yet I want you to buy this one. I want you to go out and get this one. So I love what you're doing, but once in a while you'll talk on TV or in columns and say, look, the fiscal picture is just terrible. We've got to raise taxes. And I just say that I think at this point you see a lot of what's going on in Washington, that basically we have sociopaths in charge, and it's not like it's just bad people in charge of a good system. The whole system is absolutely corrupt through and through, probably beyond reform. So why are you so concerned that these people be able to pay their bills? So what if the thing collapses? Who cares? I mean, and also, if you're inclined to say, well, they're going to inflate it away if we don't pay taxes, they're going to inflate it away, and that's also a problem. I agree with you, but on the other hand, I can hedge against inflation. I can't hedge against taxes.
Yeah, well, I think you've raised a fundamental issue, and it's about a debate that I try to lay out in my book and that I actually participated in during a 40-year lifetime, both in Washington for half of it and Wall Street, and that is the debate between what I call the principle of starve the beast, which is essentially what the Reagan era attempted to do, not on purpose, but that was the practical outcome on the one hand, or pay your bills, which was the principle that Eisenhower more or less successfully implemented in the 1950s. Now, since the Reagan era, most conservatives and most Republicans have kind of rallied to starve the beast, keep the taxes low, cut them whenever you can. That sooner or later will rein in big government, rein in the state, force reform, let's say, of entitlements and spending cutbacks and so forth, and that's the way to go. I have concluded that is upside down. That by allowing the state to grow and grow and entitlements to be unaddressed and this big, massive defense budget to roll forward in a world where we really don't have any serious industrial state enemies, is a result of the fact that people don't feel the cost, that is, the broad public does not feel the cost of funding the welfare state and the warfare state and the huge kind of big government lobby-based system that comes out of Washington. And I've come to the conclusion that only when you pay your bills on time every year, will the public understand that they need to send different people to Washington, that they can't have free lunches, that we can't have massive non-means-tested entitlements, that we don't need a war machine of the size that we have today. So the alternative is to continue to drift like we are now with a rogue central bank, the national debt rising and rising as far as the eye can see, and having a total catastrophe somewhere down the road, or going back to the Eisenhower principle of paying your bills, waking up the public, mobilizing the hardworking, tax-paying people of America to demand a shrinkage on the spending side in order to reduce the burden of taxes. Now, you may say, that's idealistic, that's theoretical, and my answer would be, read my book, you'll see it's not. That's exactly what Eisenhower did. He eventually got taxes down by a couple percent of GDP, but he said you have to earn it first by cutting spending, and he cut defense 30%. And I think we need to go back to that principle. You have to earn the tax reductions, you have to pay your bills, you have to tell the truth to the broad middle-class working tax-paying public as to what the real cost of this massive government is.
Well, David, we're out of time, but I want to thank you not only for your time today, but also the Great Deformation was received so hysterically by the Paul Krugmans of the world that that's all you need to know about what a truth-telling book it really is. So again, I urge people, you've got to read The Great Deformation, and you're going to say, but Woods, it's such a long book, but you're not even going to notice the pages going by. It is such a pleasure, as has been this conversation. Thank you so much, David.
Thank you very much. Glad to be with you.
All right, that's our chat with David Stockman, but don't go away because I'm giving away books. 2014 marks 10 years since my book, The Politically Incorrect Guide to American History, came out. How about that? It's been 10 years. It spent 12 weeks on the New York Times bestseller list, despite the best efforts of the New York Times, which denounced it stupidly. That obviously made it sell far more copies. So ever since then, they've tried to ignore me, which makes much more sense from their point of view. But to get your free autographed and personalized copy of The Politically Incorrect Guide to American History, join my libertyclassroom.com in the month of January of 2014. Go and sign up at libertyclassroom.com and then drop me a note on the contact page saying, hey, you bum, where's my book? Now, if you signed up before January, you got a great deal on a great website, but you can't get the book. This is for the January people only. So also, if you're hearing this in February, you should have acted sooner. So libertyclassroom.com, sign up, and then drop me a note. You can get that free book shipped out to you. And if you are enjoying the program, you can help us pay our bills here in our little Tom Woods Show office at no cost to you. When you're about to make a purchase on Amazon, just enter Amazon through the Amazon widget that you will find at TomWoodsRadio.com, and that will help us out. All right, tomorrow, the economics of Obamacare. See you then.
The Tom Woods Show.